I'm going to today, as Vicky mentioned, give you an update. Now, we're a small group, so please just interrupt if you have any questions. I guess the first thing that I'd really like to make clear is that the changes that are coming through with the financial reporting space, and I did a longer workshop over for the IPA members in Western Australia, is that this does impact not-for-profit entities, and I had quite a few accountants in the room who worked for not-for-profit entities. And it was going to be a significant change in the accounting for them, for their not-for-profits, even though that they weren't doing full-blown general purpose financial reports, they were doing special purpose. The accounting was still going to change for them, and they needed to be really aware of that. So I'm going to go through a high-level view of what those changes are to the financial reporting, and I'm also going to take you through the non-compliance, the new NOCLA that's come out from the international and our local APSB board, and what that means to you as an accounting firm, particularly if you're providing services, not just your taxation and your business services, but if you're working with others within your accounting firm that might be to do with financial planning, or anything else, any other type of advice, and other professionals that you're working with and providing advice to your clients, and what that might mean and how that might mean it will impact on your services if you come across a potential suspected breach of non-compliance with laws and regulations. So quite a significant change for accountants, and I'll let you know why they're targeting us as accountants and not others that are out there. But we're not the only ones being targeted though. But we're capable of being targeted, I guess, is where I'll lead you to. So we've got we've actually got 3 new major accounting standards that are coming in. One's revenue, one's leases, and one is financial instruments. I'm not going to talk about financial instruments though, because you need to be in a particular area to be significantly impacted by that. But I'm going to give you a brief overview of AASB 15 and AASB 16 on the leases. So with the financial reporting, AASB 15, which is, if you think about it, revenue is our most important item in the financial statements. It's something that we all go to. This is going to significantly impact all our ASX listed entities, and it will also impact our not-for-profit entities. And I'll get onto the not-for-profit in a minute. But what they're doing here, and the core principle that's changing, is it's not just about let's recognise revenue when we provide the service or provide the goods to a customer. We now need to go through a process, and it's called a 5-step process. So I don't know if any of you have heard about the model, but the 5-step process is basically thinking about now, what are the performance obligations? So a good example of that, let's just say that you're going to go into Vodafone, and you walk into Vodafone and you get a handset, and you're going to sign up also on a month-to-month contract to receive text and be able to make phone calls. What used to happen, and how do you think that Vodafone might recognise their revenue? It seems pretty straightforward. You're on a month-to-month contract, so you're going to recognise revenue month-to-month, whatever that monthly contract is. And you might be on a $50 monthly plan, you might be on a $90 monthly plan, and that's how we're going to recognise revenue. It couldn't be that hard. But they've changed that now under AASB 15, and they're saying to you, well, hold on a second, you need to have a think about what the performance obligations are. So what is it that you're actually providing? You're providing a handset, and you're providing the month-to-month ability for that client or that customer to be able to make phone calls and text and whatnot. So now they're saying is you need to attribute that revenue, a portion to the handset up front, and then the remaining amount of that can be apportioned across month to month as how it's been done before. It's going to significantly impact someone like Vodafone, someone like schools, where you walk into a school and you might want one of your children to go to a private school, and you're going to pay an upfront fee to hold a position. What's the service that's being provided? So it's really rethinking this whole idea about revenue, the exchange of goods and services. What are those performance obligations? They're also making it a bit trickier, and they're actually bringing in another term, which I'll explain to you, which is called variable consideration. And the one thing that's really, I guess for me, and I particularly think about not-for-profits in this space, and when I'm trying to explain to them on ways that they need to think about it and how it impacts on their organisation, is there's a lot of estimation and judgments involved in this new standard. So what the accounting standard's now asking you to do is that you need to understand your business, and you need to determine what your price is going to be, or what price you think you're going to receive from your customer. So you might always give a customer a discount. And there's this standard saying to you, well, from day one, you need to account for that discount up front. So you need to recognise revenue at a lower amount, not the higher amount. So you can't go 3 months down the track and then go, okay, well, there's the discount and I'm going to reduce or take it up as an expense. You need to think about what needs to happen on day one. So it's very much a different way of accounting. It's a very different way of thinking about your business, because you have to sit down and categorise all your contracts, or categorise all your types of services or products that you might be supplying, and saying, well, what's my customary practices that I'm used to dealing with my customers, and do I provide discounts? Do I provide refunds? Do I give bonuses if they reach a certain volume, type of thing? So, and this standard's applicable. The prior year is applicable from next year. For a not-for-profit, it's been deferred for a year. So you've still got another couple of years if you've got a not-for-profit. And as I mentioned before, if you've got a not-for-profit that's registered with the ACNC, then you will be required to apply this standard as well as a new standard. So just to make it a bit trickier for the not-for-profits. And the AASB is working hard to try and educate as much as they can, not just for-profit entities, but not-for-profit entities as well, so that they can understand how to apply the new standards. So I'm not too sure if you remember what currently happens, but for not-for-profit entities, there's a standard called contributions. It's AASB 1004, and what that one did was ask you to think about whether there was a reciprocal or non-reciprocal arrangement between you and whoever you've got the contract with. So as a not-for-profit, you might be receiving a grant from a particular government agency, and what we try to do if we're working with a not-for-profit is defer our income so that our income matches the expenses as we expend the money for the purposes of that grant. With the new standard, and with AASB 1104, it was very hard to meet that deferral. A lot of us did it, and still do, but it was very hard to meet that deferral process. So with the implementation of AASB 15, which does apply to not-for-profit entities, they've introduced another standard called AASB 1058, and it's really these two standards working in combination to help you as a not-for-profit defer your income if you meet certain obligations. So to get under AASB 15, and what that means is that you're providing a product or a service, or you've got a contract with a customer, is to get you to have contracts that are in place with your government agencies or whoever's giving you the money, so excluding donations, so that you can defer that income over time so it can match your expenses. And it can be done that way if it's got performance obligations, i.e. you've got criteria you've got to meet in that contract with the provider, the agency that's giving you the money, so you can defer income over time. So if you're a not-for-profit, you need to apply AASB 15 or the new 1058. If it's a straight donation, as we know, you get donations from the public as a not-for-profit, it goes straight to revenue. So straight away that gets included in the profit and loss. I guess the one thing, and I work on a couple of boards for not-for-profits, and I ensure, and I've already, I guess, made sure now that it's in place, that my organisation that I work with, that it's very clear in the contracts where we get money from government agencies, that the government provides our not-for-profit money, that it's in the contract, specific performance obligations that we have to meet or criteria, and therefore I'm receiving income from the government for the benefit of the community, for the purposes of what I got it, but I can defer the income, and I'll still be able to defer that income under the new AASB 15. So AASB 15 will be applicable to me as a not-for-profit, and I'm not a large not-for-profit. The few not-for-profits that I work on are medium-sized not-for-profits, but this standard would apply to them, both of the standards. Any donations I receive will be under the new AASB 1058, and it'll be recognised as income straight away. I'm just going to pause there for 1 second. Has anyone got any questions? It's a very high level overview. Any questions on the revenue? Yep. Sporting association? Yeah.
If supporting association with annual membership, the treatment of those, because depending on the organisation, they have different annual timing years for their activities. How will that affect the treatment of that annual membership?
Yeah. So you've got, I mean, I think it's still going to come under, and there's still talk about the treatments of all of these things, but I think with that membership, it'll still come under, you've got a contract with the customer, which is to provide what's the benefit that your members get, the use of the facility and whatnot. So it will be, you've got that contract with the customer, AASB 15. I'm assuming now is that recognised over the 12-month period for which it applies to, depending on when they've paid? Correct. And that treatment will continue, because I think you'll still come under you'll come under the new AASB 15, but for your purposes, it'll be similar to the way that you're doing it now. Yeah. Yeah. Yes. The only question I do you have any joining fees for a new member? So what happens, and that's what comes up in under the new standard, AASB 15, how do you treat the joining fees? So at the moment, you probably take that up as an upfront fee straight to revenue, and this standard would now say to you that now needs to be split over the membership period, or over the life that you would expect that member to be a life member or a member, and it could be 2 years, 3 years, or 10 years. So. Yeah, it makes it slightly more complicated. You know, is it any better? You know, some of our smaller organisations like the clubs get affected by this, and it's up to people like you to pull up the treatment under these new standards. AASB 16 leases. So significant change here. Again, my not-for-profits being affected. I've got 2 not-for-profits being affected by this standard. So the changes in this standard and again affects not-for-profits as well as for-profits. So the changes in this standard, as you might know, you've got lessees and lessors. If you're a lessee and you have finance leases and operating leases, where do your operating leases sit? So you might have a lease to be able to rent the premises of the building, because that's where your office space is. That usually gets disclosed in the financial statements as an operating lease, and it sits off balance sheet. The changes in this accounting standard says, no, we're changing all of that. There's no such thing as sitting off balance sheet anymore, and we're going to bring that on to the balance sheet. So what that effectively means is if you have a lease for a building, you've got your office equipment leases, range of leases that you might have as a business, not-for-profit or for-profit, all of that's coming onto the balance sheet, and you're going to have an increase in leased assets and an increase in your finance liabilities. So imagine explaining that to your members if you're a not-for-profit or some type of member club. Yep, under this new standard. So similar to the finance lease. Yep, so good question. So the question was, if we're going to bring these onto the balance sheet, all our operating leases, and we're going to make payments, how do you reduce the liability and what happens with the amortisation now? So similar to the finance leases, you'll have the lease liability sitting there as, you know, the amount of the future payments that you owe. You'll have the principal repayment. You'll have an interest component, similar to the finance one, and you'll be amortising or depreciating the leased asset. So the leased asset, say it was a building, it will be called the right to use. That will be the new name of the balance sheet item name sitting in assets. Yeah. So I think I've got, I might have put the accounting entries up here. Yeah, I've put it on the next slide, so I'll go to that in 2 seconds so that you can see what impact that has. The only thing that I'm going to point out, I mean, there's a revised definition, there has to be, because they're not just talking about any leases. Oh, question, yeah.
Sorry. We've got 2 sites that are leased at zero consideration, effectively from the Northern Territory Government. How does that... I've heard one idea where we have to actually value all of that and put it actually into an income line. Is that true, or is that not correct?
I think, without knowing a lot about it, we're all at the beginning stages of working with the transition of this, adoption of this new standard. I think what you might be hearing is on transition, you need to take up the values, and there's going to be, there quite possibly is an impact to your profit and loss or your retained earnings to get it on balance sheet in the first place. And it will come down to appropriate disclosure to explain to the users what that impact has been and why. But technically, most of it should be chewed up in the fair value of taking up the right to use asset, the future payments that you need to make in the liability, and they shouldn't be...
They're zero.
Yes, it shouldn't be too far out, but there might be... Look, I haven't worked through a whole lot of them just yet. I'm working through with an ASX that's got listed entity that's got over 100 properties in different scenarios. And as we dive into the different intricacies and the contracts, there shouldn't be an impact on the people. But I say that, and I need to work through some more to know if that's really going to be the case. You've got this catch-up scenario as well, and depends which approach that you take on transition, modified, retrospective. Yeah.
Okay.
Is your entity a not-for-profit, or is it?
Yes, it's a DGR, full charitable status, and it's a drug and alcohol services rehab. The whole rehab centre is one.
Yep.
And the admin and sober up shelter and other operational offices are another area.
Yep.
All owned by the Northern Territory Government, made available as a lease.
Yep.
At no consideration, whilst ever
it's a peppercorn lease.
Have the contracts to...
Yeah, it's a peppercorn lease. So yeah, sorry, I missed that part. It's a peppercorn lease. I've got a similar scenario, community housing. So the not-for-profit's managing the housing.
Yes.
The government owns the properties. It's a peppercorn lease, so it's not actually charging the not-for-profit anything to manage those properties. And the not-for-profit gets the income to manage those properties and those that can't afford affordable housing. Yes, there's going to be a P&L impact, but how we deal with that, it should be separately identified so it's very clear that it's hitting retained earnings rather than our normal revenue, because that's what we don't want. We don't want it to be normal revenue.
Yes, it could put a very distorted picture out there if you recognise all that income from the last 30 years.
Oh, absolutely. Absolutely.
It would be crazy.
Yeah, absolutely.
Yeah.
The only thing I'll mention here on the new definition, it needs to be an identified asset. I mean, that would sound kind of strange. Why wouldn't it be an identified asset? And the only thing that they're saying there is if you can't actually say that you've got an area that you're renting or a space that you're renting that can be identifiable, that's actually located in the one position, generally speaking, then you don't fall under this standard. For example, if you were located in an airport and they moved you and you had no discretion or no control over where you were going to be moved, you might just be in the middle of the airport with some type of shop selling jewellery or whatever. You might not come under this standard at all. Generally speaking, though, that's a good example of what we've just been talking about and that type of housing situation. I think what I might show you now is just the entries and the impact. So we already had a question over here. It's just really important to note that we're going to have what we call this right to use asset. It'll be counted for as a tangible. The reason why I put tangible in brackets there is because sometimes for purposes of reporting externally, sometimes we need to put in the forms total tangible assets. This will be treated as a tangible asset. It affects ASX listed entities. You'll have a lease liability. You'll have an impact on your income statement where you will have now interest and depreciation expense as previously with your operating expenses, you would have had just your operating expenses or your rental expense that would have come through on your P&L. So that will be the new accounting, so very similar to your finance leases. There is 2 exceptions to this AASB 16 to having to put all your leases on the balance sheet. One, short-term leases. Now that doesn't mean you go and sign off agreements like your building or your land type of leases and say, let's just make them 11-month terms and we'll just keep rolling the leases. The standard says no, you've got to look at the entirety of if you're going to keep renewing a lease. But if you have short-term leases, and it could be for some minor office equipment or something like that, then that gets excluded. That can just be treated as what we used to do under the operating leases. And if you have low value assets, they did put a figure there for the low value assets. So the low value assets, if it was less than around $4,000 or $5,000, then you didn't need to apply this standard in terms of putting it on balance sheet. So that could be, for example, some of your office equipment might get excluded because it doesn't come into this. Yeah.
20th of February next year.
Yeah. Oh no,
yeah,
that's
not-
okay.
yeah.
That's still short term.
Not needed to be recorded, still within the 11-month or short-term listing, but
Correct.
across financial years is not an issue.
Not an issue. No, you're looking at the contract. Yep. Yep. Good question. Yep. So just reiterating that we're removing our cash flows relating to rental expense, and we're including our principal components of our lease payments in the statement of cash flows. For those companies that have significant leases, this is something they actually have to go out and communicate to their investors. Now, for those that are working with not-for-profit entities, you know, it's not a bad idea to do some quick calculations and have a think about, or get your clients to start having a think about how they could communicate that to their members if members are, or the public is looking at those financial statements, so they're not shocked by the change. The other option, or the additional option, is to obviously include in your financial statements some disclosure around the transition and the impact and what it means in cash and non-cash terms. And please speak to me if you need later, if you need any help or assistance with that. I just thought I'd put this up there. So that's the new financial reporting standards. I'm going to go into non-compliance of laws and regulations in a minute. I've just put one slide up here on integrated reporting because I'm quite passionate about it. But it's just one thing to say that the ASX not long ago put in a change to their core principles, and their core principles change was to have ASX listed entities put disclosure around their governance on sustainability and what the company is doing to meet that. I'm quite interested in that area, and one thing that I go and I try and have a look at is what the organisation is doing around managing climate risk. So whether it's a physical risk or a transition risk, because their energy prices might be going to have to skyrocket in the next 10 years. But also, how do they look after their employees? And I thought that's interesting as well, because we've got this non-compliance of laws and regulations coming up, and there's so many things coming out in the press at the moment with, you know, organisations not having done the right thing. And you look at wage fraud, like Caltex and 7-Eleven, and that's been out there. Even though were their franchisees, you can't tell me that the franchisor shouldn't have understood or known anything about that. I'll just touch on this quickly before I get on to non-compliance with laws and regulations. The one thing I wanted to say about the ACNC, so the regulator for charities, is they are very, very heavy on their monitoring of not-for-profit and making sure as that charities are complying with their annual statements and lodging on time, and that if there is any reported, whether it's from the public or an auditor or whoever's doing the review of the financials, that they do follow up on that. They're also really trying to reduce the red tape, so they have worked quite well with some states. Some states it's more difficult, because as we know, not-for-profits can be companies limited by guarantee or incorporated associations, and it's been quite difficult state by state. Some not-for-profits have had to report more than once, so to the ACNC and then to some like the Office of Fair Trading or something like that. So they've been working hard, been some successful in some states, more so than others, but they keep working on that. They have continued to ensure monitoring. They do deregister charities. I was involved with a charity just recently who wasn't complying. Unfortunately, they just had a CEO that wasn't doing the right thing. And they were very onto it. And it was pretty much, if you don't report by this time, we'll give you an extension, but if you don't, that's it, you lose your licence, which causes huge amounts of complications for a charitable organisation. The other thing that they do is that if you are under investigation, they actually publicise that. So like ASIC publicises anyone that they're investigating or that they've entered into an enforceable undertaking, the ACNC does the same thing. So they will publicise a particular charity that has an enforceable undertaking with them because they've breached something. They've breached some particular non-compliance. Usually it might be financial, and they're being investigated for maybe stealing funds or something of that nature. So now getting on to non-compliance with laws and regulations. So I know that you might be aware of some of this. I'm hoping that you might be aware of some of this. So hopefully this will reinforce some more about what does this all mean. So effective from 1 January 2018, and it affects all accountants. So it's not just accountants in accounting firms, it's all accountants that are a member of the IPA, Chartered Accountants, or CPA. So if you're a member of a professional body in Australia, of one of those three, then you're affected by the changes in the ethical code. It's the same at the international level. And basically what it's saying to us is if we come across an instance of non-compliance with laws and regulations, I know what you're going to ask me next, which laws and regulations, then we are obligated to do something about that. And then you're going to ask me, well, why are we obligated to do something about it when we're not the ones that did it? And it's because at the international level they need help, regulators crossing borders, so many things happening, and they think accountants are the ones that are out there. We're like the gatekeepers because we're out there in the community, we provide a professional service, we're held highly regarded amongst our public, and therefore at the international level and now at the local level think that we have the capability and therefore the responsibility to assist with this non-compliance with laws and regulations. So it basically means that in our instance where we've got clients, if there has been an instance or a suspected instance of non-compliance with laws and regulations, then what do we need to do about it? We need to understand the matter. So we need to go and talk to the client about or investigate more about, you know, what's this all about. And we need to then communicate to them, well, you know, what are you going to do about that? You have a responsibility now to comply. If you think about all the things that a client could possibly breach, and I was just in the privacy session that was on this morning, which was a really interesting session. There's many areas of laws and regulations that this standard is trying to capture. So it's trying to capture anything to do with compliance with tax. So, you know, being compliant with the tax legislation, data protection, money laundering. I mean, look what's happening with CBA at the moment with the money laundering and then their non-compliance of reporting to AUSTRAC when it was meeting or not meeting the threshold. We've got 7-Eleven. There's so many instances of non-compliance that we're seeing in the papers, and you have to ask yourself, if you were the accountant in that business, what would you do now, knowing what we're obligated to do under the new ethical rules? So the new ethical rules is telling us if we come across a non-compliance with laws and regulations that we're aware of in our role. So we're not having to know everything. So I'm not saying you have to know everything about work health and safety and whatnot. So it's in your particular area. But if it's obvious and it's in front of you, it affects the numbers in your financial statements or the disclosures in there or the operations of the business, then you're obligated to do something about that. And the step that they're asking you to go further on is basically to ask yourself, is further action required in the public interest? Do you need to, as an accountant, when you come across this, go and report this matter externally, not just to the client, not just to have that communication with the client, but actually go to the authority. So what happens if you have an instance of non-compliance with your client who's technically not doing the right thing under ASIC or under the ATO rules? Would you then, and the client doesn't want to do anything about it? I had an example thrown at me just recently where this particular client picked up a job from a previous accountant. They were the auditors, but they got the tax people to do their tax due diligence as part of taking over the job, and they found an error in the advice that was given. What that meant was a material change to the number, and the amount that was payable. 2 tax returns needed to be relodged. The client said, no, we're not going to do that. We'll just wear the risk and we'll move forward and do it right moving forward. What would you now do under this new changes in the ethical standards, knowing that the client's not going to relodge the tax return? Decline, what was that? Decline the client? Yeah, so, and I guess that's another thing. So what the standard actually talks about that, declining or withdrawing from the engagement doesn't mean you turn a blind eye. So it's saying to you, hold on, stop. Yes, you can withdraw, but you also need to follow through with following up with that client and considering whether or not you should report that to the appropriate authority, i.e. the ATO. I know. Can you imagine what this is like for the auditors, because they're in there with the clients, so there's a lot of responsibility. Now, for them to communicate not just with the client but with the firm as well. But then there's an added element to this. So this is not just for you as an individual, as the accountant, but what about other people that you work with in your practice? So you might do financial planning, or you might have someone that you work closely with that does financial planning. You might have legal professionals that work with this. They are also impacted by this in the sense that they need to tell you or alert to you any instances of non-compliance. So that can be something quite hard to manage when they're not the accountant as such with the client, but they're impacted by this as well. So yeah, I mean, one of my first key things is really have a think about your client base at the moment and which ones you might be, or always have been, a little bit worried about, and consider whether or not you still want them as a client, because if you think about anything that comes back on you, you really need to be compliant with your ethical responsibilities, because that's how your insurance for your practice stacks up, because you are compliant. I just thought I'd talk about, I've already mentioned to you 7-Eleven, but I thought if I just touch on a couple of other non-compliance ones. I spoke about AUSTRAC, but Tabcorp, that civil proceedings with Tabcorp, and again, that was them not reporting certain information of fraudulent accounts to AUSTRAC on time, or actually not at all. They obviously didn't have the governance or the processes inside. Imagine being the accountant there. And the fine or the penalty against Tabcorp is one of the biggest penalties that have been given out by the federal court, so it's huge, absolutely huge. More than 40 million. So it was a really big number. I can't remember the exact number, but it was more than 40 million. So they're really starting to try and crack down on, I guess, on this type of, all these types of areas, particularly money laundering. And I mean, we know about the BHP one. I was listening, or I had a read of the annual general meeting of the outcome of the BHP and the Brazil mine disaster, so where people died from that disaster, work health and safety. But we've had a number of instances come across here with, even with Leighton's, with work health and safety. Volkswagen and the diesel emissions scandal, so ACCC got involved in that and they got fined over the diesel emissions scandal. So, there's a lot of things happening and it's all coming out in the papers. I don't know if we're all aware of the KPMG instance that's happening over in South Africa, but that's a huge thing that's gone on there, where you've got people in an accounting firm that have actually left now, that potentially were connected to providing professional services to a wealthy family over there, connected to corrupt president and whatnot. And now you've got a whole accounting firm that's where you've got clients that are leaving over that. So I think where we're going to go with this though, because one thing that when these changes came out, and one thing that resonated quite strongly with me, that's great that we're pushing this, and that we've got that accountability and responsibility to have to implement this non-compliance and these breaches, and to have a think about reporting and reporting it to who. How could we possibly be across all of these laws and regulations, and where do you draw the line? And I think we're going to learn by examples. I think things are going to happen, like the KPMG thing and the wage fraud that they're finding, and we're going to learn by examples, and it's going to be publicised. And you know, I'm just hoping that we can draw the line at something that's sensible for us as accountants, that, you know, in a way that we can manage. Whilst upholding the new ethical rules. One thing that I haven't put on these slides, but it's really on whistleblowing, and I thought I'd just bring that up. But if you have a think about any organisation, particularly not-for-profits that you're working with, who do they go to inside the organisation if they think there's been a non-compliance? Who within your client's organisation, who will they go to report a matter of non-compliance? Particularly if it happened by someone, and let's just say it was fraud, someone stealing money. How could an accountant inside the organisation report to someone in the organisation when the person that's superior to them is the one that they suspect did the fraud? And so a big thing that's going to come out now is everyone's internal whistleblowing protection policy. And where can they go externally if there's nowhere to go internally? Now, I know for a lot of not-for-profits that I worked with, they just weren't large enough organisations to be able to have an internal whistleblowing protection mechanism for someone to be able to report within the organisation. So I think there will be a need for an external whistleblowing where someone in the organisation can go externally, and then appoint a few people within the organisation that they can go and discuss the matter with independently. The Minister in Australia is working on a regulation to push companies, particularly large companies, that they all must have a whistleblowing protection policy in place, but also an internal mechanism for which employees can go through, a channel that they can go through if they need to report a suspected or identified breach of non-compliance. So, and just a reminder that this change affects all accountants, and it's not about turning a blind eye. So if a matter of non-compliance comes up, a breach, whether it's fraud, money laundering, some non-compliance with a particular law or regulation or aspect or licence that's important to that organisation, you need to understand it. You need to go and speak to someone within the organisation, and you need to have a think about whether you need to report to anyone externally, i.e. a particular authority, whether it's ASIC, ATO, or whoever the regulator is. In the instance that I worked with just recently, it was the Register for Community Housing and the Department of Family and Community Services. So that's who I had to liaise with, including the client. Look, there are other changes coming through with the changes in the ethics code, and it's a whole restructure. And the way that that's going to impact on you is, the main change for you is going to be the non-compliance with laws and regulations, which has already been implemented. The other changes really are, it's just a reshuffle, and it's just swapping things around. It's just a restructure. They just think it's going to read better. But I wouldn't say at this stage anything's going to be significantly impacting on you. I just thought I'd put these last two slides up before I finish. Just an auditing update. And the main thing there is more focus on the auditor. It always will be on audit quality, and that always continues. But also with non-compliance with laws and regulations, if you have any entity that you have to deal with an auditor and you come across an instance of non-compliance with laws and regulations, you do need to have a think about whether you report it to the auditor, so that the auditor has a fair chance to deal with that non-compliance, so you have an ethical responsibility to consider that. Doesn't say you have to, but you have it's in your best interest for accounting professionals to report it to the auditor. And I don't know if you're all aware, but we have a new audit report, and it's the long form audit report. So any entities that you deal with, not-for-profits or other entities where you're receiving financial statements where the auditor has audited, you'll now see this long form audit report. And it's just a longer audit report. I actually think it's a better audit report. It sets it out a little bit nicer. It's quite clear about what the auditor's responsibilities are. And if you're it's particularly focused on going concern, so the ability for that company or that organisation to continue into the future. And for ASX listed entities, they have to report on their key audit matters now. And that's where that area is really about where they spend most of their attention or focus as an auditor. So I think we might finish up there. And if you have any questions, please let me know, or if you want to chat to me afterwards, I might have a quick chat to you about the not-for-profit ones, because it's an interesting one.
Question regarding Note Club,
Yep.
Because it is something that we've looked at a fair bit, and IPA has put in submissions, and it had 6 years of consultation internationally. But to me, it just seems like there's so much ambiguity around it, like what is material, potentially breaching. Can you give us any idea as to how and what sort of criteria accountants might use on a daily basis to make those kinds of judgments?
Yeah, so tax is a good example. So let's just say that example I was explaining before, where the client, there was an incorrect treatment and resulted that the tax returns needed to be lodged, and obviously they had to pay more tax. Well, if you think about the financial statements and that tax liability, it obviously impacted the tax liability by more than 10%. I'm just throwing 10% out there, but if you want to use materiality as a guideline, and you've got 10% sometimes a judgmental way that you can start from. So if it changes the figure more than 10%, of the liability side, let alone where the other figures are coming from, that's a place to start, because that's material. I think that's a quantitative example. Another example, I think, if it wasn't putting an actual figure on, if you think about the operations of a business, so you think about a business that needs a license, so they might have a therapeutic goods license, a TGA license. There might be a waste facility and they need particular licenses with the EPA for that. Imagine doing something so significantly wrong that for some reason you somehow came across it and you knew that would significantly impact on their license to operate. That's material, because if they don't have their license to operate anymore, you've got no business.